It is well known that the currency markets and the treasury markets give the first inkling of what could happen to risk assets, and it is never different. So therefore, it's very important at this point of time from an Indian market watcher's perspective as well, as we are at those heady levels, to try and understand what is it that the indications from the currency and the bond markets are. Adarsh Sinha, co-head of Asia FX and Rate Strategy at Bank of America, is with us to try and give his insights on the same. Adarsh, great having you. Thanks for taking the time out.
Thanks for having me.
Now, the pleasure is ours. Adarsh, a broad brush question. I mean, when I look at the last couple of months, and I'm starting with the mother market and then the resultant impact on the others, the news around US economy have been anything but bad. If any, they've largely been encouraging, even on the inflation front, at least the core inflation. Somehow, after the initial burst of maybe a corrective move in yields and equity markets as well, but yields in particular, we've seen hardening of yields. We've seen the dollar index strengthen as well. What do you make of what a lot of people would call a dichotomy?
Yeah, sure. Look, I think for the US, definitely a lot of investors and a lot of analysts, ourselves included, have been surprised by the resilience of the US economy. And you only have to look and see how many economists are changing their forecasts from hard landing to soft landing for the US economy. It kind of tells you it has been a surprise. But what I would emphasize is specifically what has been the surprise in the US economy. What is driving the resilience of the US economy? It's the service sector. You know, everything the central bank, the Federal Reserve cares about, the labor market, CPI inflation, the consumer. If you look at the details, the resilience is being driven by the strength of the services sector. I mean, just to give you an example, if you look at the latest jobs numbers in the US, 60 to 70% of jobs growth is being driven by services. And therefore, I think, as long as the service sector stays resilient, yields will remain elevated and the dollar will remain strong. The question is, when do you get signs of a turn in the service sector? And the latest leading indicator that we had, which was the ISM services last week, was stronger than expected. It's giving very little indication that the service sector is turning. At some point, I think it'll turn. There are some tailwinds. There's catch-up hiring in the services sector. There's obviously an excess savings dynamic in the US that hasn't ended yet. At some point, these tailwinds will go away and the service sector will slow down. But to me, it seems more likely to happen in 2024 than in 2023. And that's part of the reason we think, US yields, particularly at the front end, will remain elevated. The dollar will remain strong. And of course, the Federal Reserve, the central bank, will continue to push back against any suggestion or idea of rate cuts anytime soon.
Okay. That you would believe this to be the base case, even if we have CPI data coming out this week from the US, and if that data also shows a very contained core CPI inflation, and because that would be the second or the third month in a row that I presume that happens, and if that continues, even then your view remains that a larger portion of the action will only happen in 2024.
Yeah. So the first thing to say about this week's CPI, this week's CPI inflation number, we actually think there are upside risks to core CPI. Okay. So our forecast is 0.2, but we think a 0.3 is actually more likely than a 0.1, which, as you say, would be quite a big surprise because we've had a few months where core CPI has been soft. Secondly, I think this CPI matters more around whether the Fed hikes rates once more or not. I think everyone agrees the Fed is going to pause in September, and then they're going to assess to see whether they need to hike again at the November meeting or the December meeting. So I think this core CPI matters in terms of whether they hike once more or not. But as far as 2024 is concerned, 2024 is less about another rate hike and more about whether they cut rates. And I think even if we see some deceleration in core CPI inflation over the coming months, that's not going to be enough for them to say, okay, we may have to cut rates at some point in the first half of next year. I think the message from pretty much all Fed officials has been quite clear that they want to keep rates higher for longer, which in my mind means they're unlikely to cut rates in the first half of 2024.
Okay. Now, I've read a few of your notes that you've authored in the last, a fortnight, if you will. What comes out from there, and something that you referred to in the first answer as well, that you seem to be constructive the US dollar. At the same time, I believe in one of the notes you said that a lot of it would be centered around actions that happen in China on the stimulus front. Can you take us through your thesis and what happens either or, if there is a proper stimulus given by China, or if there isn't, because frankly, it's a bit of a guesstimate as to what China does these days.
Absolutely. Look, I mean, just taking a step back, when we talk about the US dollar, I think most people talk about what we spoke about so far, which is the US interest rates, Fed policy. But I've done quite a bit of work to show basically the dollar move since 2022. Yes, a large part of it is down to Fed policy and interest rate differentials, but an equally large part of it is just down to the China economic slowdown, and particularly the disappointment around growth after the reopening. I won't go into the details, but I would say around 30 to 40% of dollar appreciation since the beginning of 2022 is simply down to China. So my point for a long time has been you cannot have a sustainable dollar downtrend without a China recovery. And I think we all recognize you cannot have a China recovery unless and until you see some meaningful big bang stimulus. Now, I get this question a lot. What do you mean by big bang stimulus? Because China has been cutting rates. They have been providing support for the property sector. They have been providing some support for local government. So what do you mean by big bang stimulus? It's quite simple. You need central government balance sheet expansion to support the consumer, to support the property sector, to support local governments. And we haven't seen that yet. Since the Politburo in July, we've seen a lot of easing measures, but we haven't seen kind of this big bang policy stimulus. When we survey our clients, expectations are quite low. I think in our latest survey, 49% of clients thought that we'd only get piecemeal stimulus measures as opposed to big bang stimulus. So, that's what you need for recovery in China. And as you say, it's very, very difficult to tell because these days decision-making in China is very centralized in President Xi's office. So there's very little visibility on when that stimulus might come. It's the same thing as the reopening. The reason the reopening came as a surprise is people had no visibility last year on when that decision would be made. So the best way I can put it is that, China sentiment is very, very negative right now. People are very bearish. So the hurdle for a positive surprise is perhaps quite low, but it's not clear if and when you get that big bang central government driven stimulus, which would lead to some bottoming in growth expectations, which is what everyone's looking for right now.
Should it not be a big bang one? And should it be a piecemeal, small token things because there is prosperity for all? And we've seen some actions which don't inspire confidence about necessarily a big bang stimulus. What's the resultant impact on the US dollar? And what would be your thoughts about what happens for the rest of the calendar to that, assuming that there is no big Chinese action that comes about?
Yeah. So firstly, I think we have to think about it in the context of China's growth target. So China set a growth target of 5% for the current year in March of this year. At that time, people thought, why such a conservative growth target? But that's what the growth target was. And I think having missed their growth target for a couple of years now, the incentive to meet that growth target would be quite high. So right now, our growth forecast for China for this year is 5.1%. I think the consensus is around 5%. But I think if you see another couple of months of weak data, and it looks like they're going to undershoot that growth target, then that might be the trigger for them to do something. But to answer your question, what if they don't? What if they continue down this sort of road of piecemeal stimulus measures? Growth generally remains weak. I think the dollar has to strengthen. We think euro dollar goes to 105, dollar yen probably goes to 150, dollar CNY goes to 7.4. And the idea here is very simple. If China's import impulse is weak, that's a lot worse for countries like Japan, Germany, a lot of countries in Asia than it is for the US. The US export exposure to China is actually very low as a percentage of GDP. So in relative terms, the US dollar looks a lot better when China is slowing down.
Got it. Adarsh, there was this survey that you guys did, right? Which is the FX and rates sentiment survey. A bunch of takeaways there. What I'm trying to understand is, where would you as an expert who looks at this space so closely differ materially from what the sentiment across a large set of respondents was and why?
Yeah. So look, I think one of the main takeaways from this FX and rate sentiment survey is that global asset managers are very long duration. Or in other words, they're long bonds, government bonds across countries. And by the way, this is part of the reason yields have kept moving higher, because this asset manager real money community has been trying to buy bonds as yields have been moving higher, and positioning is very long, and so the price action has been quite against them. Positioning is usually a contrarian indicator. So I think that's one of the main takeaways we've taken from the survey over the past few months is yields are moving higher. Yes, fundamentals is one thing, but positioning is wrong way, and that's why yields have been moving higher. I think for that to change, like we wouldn't necessarily disagree with this longer term view that eventually long-term bond yields, 10-year treasury yields should move lower, maybe back towards 4% by sometime early next year. But I think we need to see clearer signs of a slowdown in the US economy, which goes back to the first point. We need to see a service sector slowdown, if not a service sector recession, to be confident that 10-year yields across countries in the US, Europe, and elsewhere will start to move lower. And of course, right now there are no signs of that, but maybe by sometime next year we see more signs, and then the clients are right, investors are right, and it makes sense to be long duration.
Okay. The other aspect is an indicator, I believe, that you have, or a measure. I've written this down, wherein I think in the 10th September note that you wrote, you mentioned that, the point is that the export weakness largely a major headwind for Asia FX, but your export data surprise measure recently turned positive. Now, what is the implication of something like this? Because you mentioned that the signals are unlikely to be indicative of some early signs of a recovery as well.
Yeah, look, we've seen this for India as well, but it's not just India, across countries within the region. Yeah, you're seeing tentative signs of trade numbers surprising to the upside, and particularly the export numbers have been surprising to the upside. Still very weak, still falling in year-over-year terms, but expectations are so low that that you're seeing these positive surprises. So usually when this happens, people say, okay, this should be good for Asian currencies. Currencies should strengthen because export numbers are surprising to the upside. And the point I make in that note is when you look at some of the lead indicators for Asia's export cycle, so you look at new export orders, you look at shipment to inventory, you look at the tech cycle, it's far from clear that this is going to be the big bottom or the big recovery in export numbers for the region. And that's why I make the point that this is perhaps not the right time to be long Asian currencies. India is a bit of an exception, though. We all know that India export exposure to China is a lot more limited. India exposure to tech exports is limited. And we know the resilience in India's exports is being driven by service sector exports and service sector exports to countries like the US. So I think India's export dynamic is a little bit different because it's being driven by service sector resilience that we were talking about earlier in the US and other countries. But for the rest of Asia, I think it's a lot more about China, it's a lot more about tech, and the leading indicators for this kind of stuff is not that encouraging yet.
Adarsh, one final question. And a slightly maybe both encompassing both the short and the medium term, India specific. Service exports, as you mentioned, continue to stay strong. Commentary from IT companies seems to suggest that, for example, if not in 2023, then we might see a beginning of a bit of an uptick, say 2024, assuming that happens. That's part one. Part two, a bunch of global companies setting up shop in India to manufacture for India and for the world. And we've seen some green shoots there in mobile phone exports, so on and so forth as well. And three, the third part is that with the kind of reserves that the central bank is sitting on and the interventions that we've seen, they're kind of maintaining the rupee a bit more steady as opposed to some of the other currencies. So one might argue that we've actually had a very sharp depreciation move in the preceding 12 months than what's happened in the last 6. But my question is, do you reckon that the Indian rupee could fare a bit better because of these and some other factors as opposed to some of the other currencies, should there be a general strengthening of the US dollar index over the course of the next 12 months?
Yeah, good question. Look, I completely agree with you that the balance of payments backdrop for India is quite good. We're estimating a current account deficit of about 1.2% of GDP, which is very good. I mean, that can be easily funded by FPI and FDI inflows. You talked about the manufacturing cycle. Actually, FDI inflows have disappointed a little bit in the current fiscal year, but of course that could start to pick up. There's of course talk of potential bond inclusion, which could add to some inflows on the debt side, and equity inflows have been quite resilient anyway. So we are forecasting a BOP surplus for the current fiscal year, which generally should be good for the rupee. And as you say, the Reserve Bank of India's FX reserves are, they built up their FX reserves to a reasonably adequate level. Definitely FX reserve levels are not a concern. I think the issue here is, as you say, the dollar is strong. The way the Reserve Bank manages the currency is obviously they would accommodate a higher dollar rupee if the dollar is strengthening versus everything else. So, whereas the dollar rupee range has been 81, 83 so far, maybe it shifts to a range of 82, 84 if the dollar continues to strengthen against all other currencies. However, to your point, if you think about it in relative terms against other Asian currencies or against some of the other G10 currencies, yes, I think there's a case to be made that the rupee should do relatively better than other currencies. And that's the way we sort of we have been expressing this to our clients, which is maybe you don't necessarily want to be short US dollars versus the rupee because the dollar is still strong, but in relative terms, the rupee should do better given the balance of payments backdrop.
Okay, sorry, I rephrased. This is my last question now, should you have the time. Just one more slightly longer term question. Traditionally, we've always or usually seen circa 4% CAGR depreciation for the rupee. I mean, a year or there notwithstanding, but that's been the average. Should we become CAD neutral? I don't know if it happens, but there's a lot of talk of that happening and multiple levers to that as well. But should that happen in the next couple of years, if you will, can the Indian rupee, can the Indian interest rate sensitivity be materially different for the rest of the decade than what it has been for a better part of India's history?
Yeah, it's a good question. I mean, as you say, the other way of putting this is dollar rupee has always tracked the FX forwards. So it's been very hard to beat the forward market in dollar rupee because it just sort of compensates for the interest rate differential. Does that change? I think it depends on two things. I mean, it does depend on structurally where's the current account over time. Like, I'm not sure like India can manage a sustainable neutral current account for a long period of time because of the demographic profile. Usually when you have a young population, the equilibrium current account tends to be a deficit rather than a surplus because that's the nature of the savings investment balance. But yes, I think if there's a smaller current account over time than what we've observed before, maybe the rupee can outperform the interest rate differential a little bit more than it has over the past 10 years. But I think the other important element here is, again, how the Reserve Bank of India manages the currency. Like, if you talk about India's motivation to be a manufacturing powerhouse, kind of keeping the currency structurally weak makes sense. So if that's the policy, the FX policy reaction function that the Reserve Bank and policymakers in India want to have, then it's a bit harder to say whether the rupee can necessarily benefit a lot from this transition. So yeah, an interesting long-term question. I think the relationship will be a bit different over the next 5 to 10 years over the long term. But does it necessarily mean that the rupee appreciates a lot as a consequence? That's not as clear to me.
Okay. Fair call. Lovely talking to you, Adarsh. Thank you so much for taking the time out. It's the first time that we've spoken. We hope that we can get you more often on the platform.
Great. Thanks, Niraj, and thanks for inviting me.
Now, the pleasure was ours. And viewers, thanks for tuning in to this very special conversation.